Good evening, everyone. This is Rodney with the Triton Wave Market Outlook for Wednesday, September 19th, 2012. I wanted to start off by looking at the relationship between the ES and the Aussie Yen cross. The Aussie Yen cross is this graph on the bottom. The future price on the ES is above, and I stretched them out so that they basically line up almost exactly. Here's a low here, the high up here correlates with this high, and this high of August 19th is this high. So, as I've said in the past, when the Aussie Yen cross goes down, risk is off. When it goes up, risk is on. So here we have an off period, a slight on period. But as an early warning system, if you look at the Aussie Yen as an early warning system, what's happening is that the S&P keeps making highs, and the Aussie Yen has only made it made a high from up here in a new high from March 20th. You can see the March 20th high across here is about 1420, and now it's 1454 up to 1466. My point is that the Aussie Yen has made a 50% retracement, came down a little bit, and has not only cleared the 50% retracement yet, but it's nowhere near the highs that it established back in March. So that's one negative for the market. Now, if we look at the chart on the left here, this line that's established the inside trend line from October of last year, and we're approaching 1 year on this. It came above the trend line and then moved back down, and it's right on it. So let's look at all the arguments for this continuing to the upside, or just collapsing and continue and starting a new leg down in the market. From a fundamental point of view, this is all technical analysis aside, but fundamentally, this news came out about 7 o'clock last night, Central Time, that the European banks over the last year have pledged to cut $1.2 trillion in assets, which equals to about 3% of their entire holdings. Well, what happened was that when Mario Draghi and the ECB infused the banks with $1 trillion in euros in 3-year loans, it took the pressure off the banks to cut the $1.2 trillion in assets. Now, these are negative assets that sit on their books, and the reason why they didn't sell them is because they didn't have to. They had a new infusion of capital, and they were waiting for higher prices. The result was, instead of being a 3% decline as what they promised, it ended up in a 7% increase. So now they have their own debt on the books at prices that haven't been reestablished to the high side yet, and they've got new debt on the books. Now, as a corollary, the U.S. banks have gotten an infusion of several $trillion with the Treasury buying bonds and guaranteeing $40 billion a month. So the guarantee is for at least the short term, maybe longer, maybe a year, 18 months, is that there's a guarantee of very, very low rates. Now, banks make money when rates go up. They don't make as much when banks go down. So what's the incentive? My question is, what's the incentive for U.S. banks to sell their bad assets when they keep getting this infusion of capital? And so they may be doing the same thing that the Europeans are doing, which is why the bank stocks went down today and took a pretty good hit. So we may expect that and more of that in the future. In other words, bank stocks going down. Now, if you look at it from the perspective that bank stocks, that the banks move a tremendous amount of capital in this country, that's not a good sign for the market to continue up. The market's not going to move up if the banks don't move with it. If anybody suspects that the banks are holding back, then that's a negative for the market. Another negative for the market is that as the S&P, you can see when this is a universal cursor, whatever moving on the right chart is moving on the left chart, is where it's aiming. The high in March is what is correlated with this high in the transportation, and the transportations have done nothing but trend down. In fact, we can draw a line here. So the transportation has trended down as the S&P futures trend up. The market is not going to move to the upside with the transportations moving down. They basically move this country. It's not just about oil. It's about, you know, thousands and thousands of companies, airplanes, trains, airplanes, trains, and cars, everything. So this is what's happened in the last 2 days with the transportation. They've gone from 51.30 down to 50.75. So that's pretty good. It's 60 point. Wait a minute. Hang on there. 52. Okay, so 130 points, which is huge. 57 today. That's not a good sign for the market going up. Additionally, the SPX was down 1.87 today. The New York Stock Exchange Index was down 21, and the VOLD, the volume up minus volume down, was well, the total shares were 632 million. And yes, it's kind of like a semi-holiday market today, but the VOLD was minus 179 million. And if we bring down this chart here, you can see that it finished on low of the day, and the volume was decreased. So basically, we're at a critical point here, whether there are buyers that come into the market regardless of what's going on and just inflate the market until it completely collapses, or we're at a turn here. But this area right here of 4 days almost sideways, and yes, this first giant candle was their Bernanke move. This giant candle was a Mario Drago move with the ECB, and we've been going sideways since then. There's been no lift to the market and no volume to support it. Transportations are moving down in the meantime. Very, very critical turning point. I'm just pointing out the differences between the rationale between the market going up and the market going down. This is besides any waves that we see in the market. And right now, the 21 period is showing T1 through T1, T2, and T3 is going down. For this market to actually move down even more and start this new cycle down, T4 and T5 will have to go below zero. So that may be a day or two away, but it may be very, very sudden, just like I'm not sure the reason why oil moved down $5 within the 30-minute period yesterday, but something like that could happen, and you have to be very, very prepared with stops in place. So let's quickly look at some of these stocks. The Goldman Sachs is extended. One of the banking stocks. It was let me see, down to. It was down 1.5 points at one point. It's gone through the 377 on the daily, and actually the waves don't look that bad on the daily, but they're slipping a little bit on the 21 minute, and you can see the day. Let me see, on Friday, beginning of Monday, T1 right here rolled over, and T2 and T3 almost at the same time, right about at 121.27. And T3 today T4 started rolling over, so this may roll over if it comes back because of the extension. If it comes back down to the 233 moving average 109, where it'll come to at least the 377 on the 21, which is 113. That's basically what I'm looking at for Goldman, considering the weakness in the waves and what's going on with the revelation of the banking system in both countries. I'm sorry, I don't mean both countries. I mean all of Europe and the United States. Amazon keeps moving up. Our target price for that is 268. That hasn't changed. It's mostly going sideways to up, and this long 21-minute dark blue wave on T5 stays above zero. So I still like that target of 268 on Amazon. Baidu, I'm starting to look Baidu on the downside now. I wasn't sure when it kicked up 3 or 4 points on Friday. Let's see what it did here. Which is the reason why I covered this 2 days before that, because it was starting the 21 on T4. The 21 was starting to go above zero. I covered it. I saw a possible target of 114, and it exceeded that. And it even started up a little bit on Friday and then started coming down again. So I wasn't sure whether this was going to go to the 377 on the daily, which would be 120, but I was willing to stay out of it just to see what would happen, because basically all the waves on the daily are below zero. What happened was on Monday, it turned around. On Tuesday, it kept that pace on the downside. So I now like Baidu again on the downside. Target is my old target of let me see, old target of 100. At least for right now, 106.66, and maybe a slight bounce off of that, and then 90, and then 99. Netflix, I thought was going to start going up again, and it did a little bit. Let me see, on T4 on 9/11, it started going above zero, and actually T3 was completely above zero here, and T2 was completely above zero here. So given that T5 on the daily was completely below zero, you wouldn't want to play the upside unless you were not risk averse and didn't mind taking some chances as a counter trend trade. But now it looks like it shot up to 61 and it's on its way back down again. And the same wave that led me out of it at 55 on the way up, T2, is now completely below zero. So it's a retarget again. I think I have a price in here. So I now expect Netflix to continue its downside move to 43.80. Okay, so that leads us to Apple. Probably the only reason why I like the market on the upside is that Apple keeps on going, but Apple absolutely cannot do this alone. So if we look at the left-hand chart here, it keeps on going and going like an Energizer bunny, and I've done a 1272 extension on this from the April high to May trough right here. It's already past the 1272 extension of 680, and it looks like it wants to hit 722. It's absolutely unbelievable, but that looks like a target. So I'm actually going to put a line on this right here. Erase that. Move that back. Reset that. So the next time I look at this, I'm going to see that'll be my target of 722 on Apple. Okay, MasterCard, for the longest time I was waiting for this all the way back since August to show some signs that T5 was going below zero. It did. It moved down a little bit. I had a profit. I didn't take it. I actually got stopped out for a loss back here. This thing has just completely taken off. The waves reversed on it on the daily and on the 21 minute, and it's a rare case that happens, but it did. It's showing signs of a little bit of being a little toppy right here with on the 21 minute with T3 going down below zero and T1 and T2 going down. So this may, from the looks of it, it looks like it has to shed a few points. My guess would be if T4 rolls down below zero, then we could see about 15 or 20 points come off of MasterCard. With regard to GLD, once it got past all this congestion on the daily, it's just been up and away. If we look on the universal cursor here and move it over to the 21 minute chart, it's gone up, sideways, a little bit down, up, sideways, up, sideways, up, and there's no reason to expect this not to just make another leg up, sideways, another leg up, because with the condition of the economy and one of the only safe havens left, on a fundamental basis, there would take a lot to turn these waves around to the negative side. So I am very bullish on GLD, but I would wait until it came down in order for an entry. Though not at these prices. And GLD looks very, very strong. It moved past this 2-year trend line. It just blew right through it. So whether it comes back down to the trend line or not before it kisses it and takes off again is a whole other question. We just have to watch and see what happens. Actually, I think it did. Wait a minute. Actually did. It came down, it went up, came down, kissed off the trend line, which on the 21 minute is the 377, and on the daily is the 21. So there's no reason to believe this is just not, this is going to move with the market. Whatever, if the market moves up, this is just going to keep on moving up. I do not have a target on this. That's all I have for tonight. Good luck trading, and I'll see you at the next update.